Hello, Internet friend. Today on Value Side, we see three major economic risks in the escalation with Iran. I'm David Ravel. Well, on Wednesday, July 8, U.S. President Donald Trump declared that the ceasefire with Iran was over, apparently ending the brief halt in the kinetic conflict. It's an unfortunate turn of events that will inevitably result in further killing and destruction. Much will be reported on the specific destruction of military bases and civilian infrastructure. The U.S. Central Command has already begun announcing the specific targets that it ordered destroyed. But while the current focus remains on the physical structures and strategic objectives of the war, there is another economic effect that may, in the end, have a far-reaching impact not only on the Islamic Republic of Iran, but also on the American home front. Here are the three specific economic risks that we see in our future. Risk number one, the petrodollar. The world began to see a schism between the U.S. and its chief Middle East ally, Saudi Arabia, in May of 2026. It was then that the Saudis denied the U.S. forces access to the Prince Sultan Air Base in its attack on Iran. President Trump had launched Operation Freedom in his continuing battle with Iran. But Saudi Arabia would have none of it. Previous attacks by Iran, ironically against that very airbase, had shown that the risk was too great to Saudi. In a personal phone call between Crown Prince Mohammed bin Salman and Trump, the prince made it clear that Saudi Arabia would not support the U.S. war. It was a major break in the alliance, and we can only imagine how the U.S. president received the news. Reinforcing the House of Saud's new stance, the House of Saud has remained on the sidelines in this week's battles, and the result has been that Iran is not attacking Saudi Arabia. It marks the end of 50 years of military support from the Saudis, and it remains to be seen how this will affect U.S.-Saudi economic relationships. Likely, that's over too. If so, it will be a major blow to the petrodollar, the most significant overseas depository of U.S. currency, and one that has been instrumental in propping up American sovereign debt. Billions of dollars have been used globally in the oil trade, dollars that will now make their way to another currency. While the outcome of the Iran war remains uncertain, it looks like the president may have risked the petrodollar and lost. Risk number two, energy. It's the multi-headed monster of the entire dispute, energy. So much comes from the price and availability of oil, gas, and derivative products. For America, the most apparent effect is the price of the gas pump. It's a simple, straightforward measure of the pain that the average American citizen's wallet is enduring. However, rising gas prices also reveals subtle forces at work in the economy. For economists, rising gas prices indicates the discretionary consumer spending will be diverted to meet this higher expense. Additionally, logistic companies will pay more to operate their trucks, planes, railroads, and ships. Add all this together, and economists have concluded that a $1 rise in the price of gasoline will result in a 1% decline in the gross domestic product. Now, at the beginning of this year, the nationwide average of gasoline of regular gas was $2.81. Today, that average price has risen to $3.85. We've reached that $1 rise in gas. And just for reference, the GDP growth rate last quarter was only 2.1%. Take away 1% GDP growth from gas, and we're dreadfully close to a recession. Risk number three, the strange behavior of the world's largest financial market. Suppose there's one thing that stockbrokers and investment managers can rely on, and it's the stability of the U.S. Treasury market. It's the largest and most secure financial asset on Earth. As a result, when times get tough, financial advisors naturally look to govies as the safe and secure way to invest. It's called a flight to safety, and it's been the way for as long as I can remember. Through wars, pandemics, and natural disasters, U.S. T-bonds have rallied as people seek safe haven investments. But not now. Since hitting a high in March, the first time the Iran struggle appeared to be ending, the 10-year U.S. Treasury note has declined by 5.5%. It's a remarkable trend, one that I don't ever remember seeing. Here, we can speculate about this significance, but it doesn't take much guesswork to see what's probably happening. Investors are increasingly concerned about this administration's lack of physical discipline. Foreign military incursions are happening one after another at a rate we've never seen before, and each one of these incursions costs billions of dollars. Now, rumors are swirling on Wall Street that the Pentagon is out of money and will have to come to Congress to request a supplemental allocation of funds. It's on top of a record-setting $1.5 trillion budget, with supplemental requests already submitted. That's just for the current cash expenditure, the cost of operation. What lurks in the future are the capital expenditures that will be needed to replace the munitions used, the planes, and the bases destroyed in fighting with Iran. There's a sneaking suspicion that we're not being told the full extent of capital losses ongoing in the Middle East. Now, if any of this turns out to be the case, it explains why, for the first time in memory, investors are reluctant to move into U.S. Treasuries. Of all the risk in this conflict with Iran, this is the most significant. As our nation that manages the largest sovereign debt portfolio, we cannot afford to lose our sterling reputation. Whether they like it or not, the administration's most important role is bond salesman to the world. This conflict with Iran and the president's erratic behavior are threatening our reputation as a solid and reliable debtor. Now, this week's economy. The preliminary report on second quarter GDP showed that the economy is growing at a middling 2.1%. The unemployment rate notched down to 4.2%, the lowest level in a year, but inflation continues to climb. For the third month in a row, inflation increased, rising to an annual rate of 4.2%. It's principally a reflection of the mind-numbing rise in gasoline prices. They're up 40% this year, a direct result of the conflict with Iran. Future markets now predict a better than 50% chance that the Federal Reserve will hike interest rates later this year. And one respected market estimates that the odds of a rate hike are now at 80%. Finally, the Bureau of Economic Analysis reports that our trade balance fell to its lowest level in more than a year, driven primarily by a 3% decline in exports and a 3% rise in imports. And imports, as you may imagine, were driven higher by the rising price of oil and pharmaceuticals. And that's ValueSide for today. For all of our articles and podcasts, visit valueside.com. I'm David Ravel. ValueSide is independently written and researched. The views expressed are strictly my own.